My name is Phuti. I'm a senior tax advisor in the tax practice at Bowman's in the Linington office. I'm joined today by Michael Rudnicki, Samir Ellary, and Mark Linington. And together we form the tax PE practice for Bowman's South Africa. We continue our discussion today talking about the global trends, private equity trends that are expected for 2024. In our first discussion, we discussed exits. In today's discussion, our focus is around the proverbial dry powder. PE firms and fund managers that have access to committed capital that is yet to be deployed. With exits on the up, this creates an opportunity for acquisitions for others. Mark, one almost gets one shot at implementing a structure upfront that needs to be sustained for a period of time, whilst the tax laws change every year. What are the key considerations to take into account when structuring an acquisition?
Well, our interest deduction rules are the biggest problem. They're not very user-friendly. If you raise debt to buy shares, you don't get an income tax deduction for the interest that you incur on the debt. There is one exception, which is supposed to fix this problem, but it doesn't fix the problem for private equity deals. It's Section 24(0), which allows a tax deduction where Company A borrows money to buy at least 70% of Company B. But this doesn't work in new private equity deals because normally you use a bid code to buy the shares in the target. So bid code gets a tax deduction, but doesn't have income against which you can claim the deduction. It does work for follow-on investments, however. This is where the existing portfolio company uses debt to buy the shares in another company. The portfolio company can then claim the interest as a deduction in its tax return. So how do you get a tax deduction for new private equity deals? Your bidco buys the shares in the target and thereafter implements an internal debt pushdown structure. This entails the target transferring its business and assets to another company that forms part of the bidco group. You end up with the business and the debt in the same company, which makes everyone happier, including the banks who now have better access to cash and assets. There are two ways of implementing debt pushdown. One is Section 45 and one is Section 47. Section 45 is generally more popular for private equity deals. It applies where assets are transferred from one group company to another on loan account or for cash. Section 45, however, comes with lots of clawback mechanisms that must be carefully managed for a long time, such as a degrouping clawback that is triggered within 6 years of the business transfer. Section 47 applies to liquidation distributions, which entails the target company distributing its business and assets and delegating its liabilities as an in-specie distribution in anticipation of liquidation or deregistration. But Section 47 introduces some execution risk, as it has more rules that apply when the business and assets are transferred. All the assets must be transferred under Section 47, which is often not possible for contractual or regulatory reasons. For example, due to licensing reasons, a portion of the business may have to stay behind in the target. Also, all landlord consents may not be obtained by the closing date, and the business conducted at those sites may need to stay behind and only transferred later once those consents are obtained. So in those circumstances, Section 47 will be problematic. Also, the liabilities delegated under Section 47 must be older than 18 months or have arisen in the ordinary course of the business which is transferred. And these requirements are often problematic. In summary then, although Section 47 is harder to implement, it may be worth the additional effort, especially if there is a chance of selling shares below the bidco within 6 years. Thank you.
Thanks, Mark. That's really insightful. And speaking of deductibility of interest, we've just come through a period where interest rates have been on the up over the past 2 years, and they're expected to remain at these high levels for the foreseeable future, even though there are expected to be some marginal reduction over the coming year. Samir, will alternatives such as NVF structures prove to be favorable in this market? And does the market understand how NVF structures work?
Yeah, thanks, Phuti. So I think not necessarily anticipating a massive increase in NVF structures solely driven by high interest rates per se, particularly I think in the PE context, bearing in mind that, if there is a need for a deployment of all this excess dry powder, what we will likely see is an increase in deal activity. And I think in that context, that's probably where we will see an increase in NVF structuring as an alternatives funding mechanism, or rather not as an alternative, but rather as a supplementary funding mechanism. Reason being, in the PE context, you often see NVF being adopted in the context of shareholders who need to be introduced into the structure, but don't necessarily have the capital up front. And in that context, NVF is still very much a favored financial or funding opportunity or option, compared to a traditional vanilla vendor loan. And the benefits, of course, are quite key when it comes to from a tax structuring perspective. In the context of a vendor loan, which is generally serviced through dividends, the problem with that is if you potentially have a potential for dividends tax leakage, particularly in an instance where there might be a BE trust or a shareholder that isn't exempt from dividends tax. So that's one area where notional vendor financing can certainly be more beneficial than a traditional vendor loan. We spoke about interest deductibility, and there again, in the context of having a trust or BE trust, a ESOP trust, that's often adopted to house an employee share scheme. Obviously, that entity is not trading, and often then in that instance where a vendor loan or traditional vanilla loan is adopted, in most cases, that interest is not deductible. Similarly, the flexibility we often find in these transactions with NVF in terms of restructuring is, of course, quite paramount, and one of the main reasons why we prefer NVF funding in that context, just because in a vanilla loan, amendments to terms, etc., can potentially trigger your debt forgiveness rules. And of course, NVF funding is often cheaper just because your graduation factor or your notional interest, if you will, is not quite restricted or limited or subject to the same terms as it might be in the context of a vanilla loan. So yeah, overall, not certainly in the context of dry powder and an increase in deal activity, as I said, I think we will certainly see NVF still being adopted, and is certainly a tax efficient mechanism in that context vis-a-vis a need to introduce shareholders or wanting to introduce shareholders, whether it be driven by BE or competition commission conditions, as it's often now seen in the market. And as I said, in that particular context, NVF definitely plays a major role.
Thank you, Sam. And I suppose it's a good thing that these structures have been in play for quite some time now, and everybody's very familiar with how they work. Michael, given that debt's still one of the funding mechanisms used, and interest deductibility remains paramount when it comes to acquisition transactions. Mark spoke about debt push-down structures earlier. Are these structures all impacted by interest limitation rules?
Yeah, Phuti, unfortunately, nothing is straightforward in our law anymore. This is just another aspect of our law that makes everyone's lives complex. In addition, this deduction limitation rule doesn't only apply necessarily upfront, it applies through a certainly proportionate lifespan of an investment and portfolio cycle. So it needs to be managed post-deal, which is another aspect of our law that is important to think about and feature in post-deal structures. So all debt push-down structures are usually impacted by the interest limitation rules, which were introduced into our law to curb the use of excessive debt in company acquisitions, and therefore limiting a higher deduction of interest. Essentially, these rules apply to interest on acquisition debt, which funds the acquisition of businesses, utilizing the tax rollover relief rules that Mark had spoken about earlier. A debt push-down structure is usually used where acquirers want access to the company's assets and liabilities directly, but are forced to acquire the shares as an initial step and thereafter to move the businesses into a new legal entity using the tax rollover rules within our legislation. The rules will typically apply to senior debts utilized to shift businesses into new legal entities, but importantly, they also extend to existing debt within the entity that is being transferred. This component of the limitation rules is often missed, an important aspect of one's analysis to address. The limitation rules are applied to what is called tax EBITDA, to which a repo adjusted rate is applied. At the current repo rate of 8.25%, 49% of the tax EBITDA, subject to further amendments, is the maximum interest deduction permissible. The interest deduction limitation rules apply in the year in which the acquisition arises, using the tax rollover relief rules, plus a further 5 years. So in modeling returns on investment, these rules are important in order to assess non-deductibility of interest. Importantly, interest that is not deductible is not carried forward to the subsequent tax year. Thanks, Phuti.
Thank you, Michael, and Mark and Samir. And thank you for joining us for today's session. We look to continue engaging with you throughout the year as these trends play themselves out in the market and or as any other new developing trends come to the fore. And thank you.